Everyone, this is Rob Roy, and welcome to the LA Wave Options U.S. Market Update. As we do each and every week, we show you on the screen the stocks that will be featured in this recording. And as a reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, let's take a look at the chart of the markets. And pretty much status quo with the markets continuing to move up. Kind of adjusted this ascending pennant pattern, but we're still moving up in it. The most important thing is that we are trading above this 10-day moving average. We wondered last week about, are we still in the program of buy the dips? And obviously we are. And then I also showed you this zigzag within the last, or the current wave 3 that the SPY is in. That's what I like, zigzags within wave 3s, because in LA wave rules, people always say stay away from it because you never know when the wave 4 is going to start. But I think zigzags really help give target prices within the wave 3. And another thing that I talked about is this extension potential on the C wave of a zigzag. We have a B wave correction at 50%. With zigzag rules, that gives you a target expectation of 100%. We hit that. We kind of went sideways there for almost 2 weeks, and now we're breaking up higher again. Oftentimes, you will see an extended C wave within a wave 3, which basically just means that the C wave extends to the next fib level, which is 161.8%. That's somewhere in the 675 area, and we're getting there. It seems likely that we'll get there, barring what's going on with the government shutdown. I'll mention that in a minute. But something else that I wanted to show you, the same chart I showed you last week, but updated on the SPX versus Fed liquidity and the divergence that is showing in those charts. You can see that the Fed continues to drain liquidity by shrinking their balance sheet and shoring up the Treasury. So liquidity is being diverted elsewhere, at least for now. How long can we stay in that sort of divergence before it affects the markets? But when we take a look at the overall picture, global liquidity against the S&P, that chart shows you that everything is okay. Liquidity is meeting the demands, which is why we haven't seen more of a correction so far. So if we go back and take a look at the chart of the S&P, the question becomes with this government shutdown. I was asked all week long during the live shows on whether or not the government shutdown was going to affect the markets. And in my opinion, it's all political theater. Neither party wants to have the government shut down for too long. Usually they do their posturing, they get their 5 minutes of airtime, they negotiate, they come to an agreement, and then we end up with some sort of a deal. If it extends too long, and they're talking now because both parties do seem to be digging their heels in a little bit during this shutdown, how long will that go on? Some people are saying as much as 2 weeks. When will it affect the markets is a good question. In my opinion, if we get to the point where federal employees miss a paycheck, then you're starting to look at more economic effects, and perhaps that could be what ends up moving the market to the downside. But for now, not a concern. It will be interesting because we are recording this during market hours on Friday, where the market ends the day. Does the market get concerned about it? Do we sell off into the close? That's what I'll be watching for. Travel this afternoon, so that's why we're doing the recording a bit early. But bottom line, looks like that 161.8% level is where we're headed. And while I'm talking about the directional movements of the markets, and people might be starting to wonder, hey, how much longer can we go directionally like this? I'd like to invite you to a special event that professional money managers, myself and Jeff Beamer are going to be doing this event. It's free. You can sign up with the link that you see on your screen now. It's called Generating Income from Trading. Any trader should have part of their portfolio on income-based strategies rather than just directional ones. And the timing for this, I think, is pretty good because at some point in time, this directional move on the S&P is going to end. So sign up and join us Wednesday, October 15th at 8 p.m. Look forward to having you there. Sign up on the link. Now let's go ahead and take a look at the bond market. I think that's pretty interesting. When we see this kind of consolidation here, I think that's interesting. Curious if the Fed with the government shutdown lasts, will they change that liquidity? That chart I showed you with the divergence, will they begin to inject more liquidity? I suspect they might, but that would have to be a protracted or extended government shutdown. For now, on TLT, and as a reminder, that's prices on the 20-year, prices and yields move inversely. We did have this kind of a move up here, breaking out from this triangle. And as you remember going back, the TLT has just been going through a whole series of consolidation in the triangles. Basically, the entire year, the only directional moves have been breakouts from these triangles. Same thing occurring now, which is quite interesting, I think. If we go back and look at the breakout just before that last FOMC meeting, prices went up and yields and rates therefore went down. Seemed like maybe the bond market was just having a little bit of protection there against a surprise 50 basis point rate cut from the Fed. Didn't happen. So right back down we go in prices. And we're consolidating here with elevated prices and therefore lower yields. I know you guys like to look at the TNX as well. So we'll take a look at the chart of the 10-year TNX, and that shows that we are basically moving in this sideways vein here to the downside. We have a wave 5 label to the downside on TNX, which is quite interesting because if we do continue lower, right now yields are going down across the yield curve, so it's flattening the yield curve. As you know, if you have a steep yield curve or a steeper, that's a healthier economy. You should get less interest on holding bonds or securities for a shorter term versus a longer term. So when the yield curve's flat, that means rates are pretty steady across the yield curve. It shouldn't be that way in a healthy economy. But right now, if we do see this movement down in yields on the TNX, I'd be surprised if we go all the way down to that wave 5. Maybe we will. It's a pretty well constructed 5-wave pattern. What happens from that point? Does the long end go down in yields and rates as well, or does the curve begin to steepen and perhaps the economy starts to improve as the Fed begins to inject liquidity back in and maybe continues on their rate cut cycle? We'll have to wait and see. We didn't get the non-farm payrolls report today because that's a government issued report, but look what it's doing to the metals. When we take a look at GLD, this chart has just been a rocket ship to the upside. Both the metals, gold and silver. I'll show you that in a minute. But we actually have uranium as one of our Top Shot alerts. And those of you that have taken advantage, thanks for your comments on Top Shot, the special offer I made on hitting 50,000 subscribers, where basically cherry pick one alert each week from our 4 primary portfolios at ewotrader.com. And a lot of you took advantage of it, and we're off to a great start with the returns, and you guys have noticed as much. So uranium's working right now as well. But back to the chart of GLD, how far is this going to go? It's surprised me at this point in time. You can see that we had this line drawn here because we did have this as an alert at Ewo Trader based on triangle rules. You look at the width of the mouth of the triangle, how far it's going to break either to the upside or the downside. We did pick the upside, so it was in our speculative portfolio, which comes along with level 3, also included in the Top Shot, by the way. We closed it out once we hit that expected move. Well, then the AI from the Hub organization, and a quick reminder, if you haven't gotten a copy of this software, you can get it for free. Go to hubb.com. You get the free charting platform. You get free Elliott wave labeling. These are not my labels, by the way. Sometimes people say I don't agree with your labels. They're not mine. I'm not doing it. It's the algorithm within the software that is programmed to the algorithm that Ralph Nelson Elliott wrote. So they're not my labels. I just do my best to interpret what I'm seeing from them for you when we do this each and every week. Well, the AI came out and said, nope, we're not stopping here on the triangle breakout. We're going up to 337, and it was right. And we went sideways there for a couple of weeks, and then we've just been taking off ever since. It's getting a bit vertical there. Probably what's playing into it is what's going on in Washington. Maybe there's a little bit of a defensive posture here with the government shutdown. Silver following suit today as well, moving higher. And the AI has given this a target also. This is fairly new, just came out about a week ago, where it says we're going up to 44 and change on the SLV, and we're almost there already. And it's only been, 5 days. And what happens there? Does that act as the same way that GLD did. Even the AI target has been exceeded on the chart of GLD. Perhaps silver plays catch up and does the same thing. Maybe it breaks through that level as well. When we go to look at the dollar, this isn't all being driven by the dollar. If the dollar was weakening and going down, then yeah, there would be an expected move up in the metals. But the dollar's still hanging around in the lower end of what I've called the Goldilocks channel here, where having the dollar stay lower helps companies from earnings. I think the earnings reports are going to be quite interesting this next quarter. I think there'll be some big winners, but I also think there's going to be some losers because there are some charts breaking down as well. But notice what's happened here in the dollar. We've formed a symmetrical triangle right at the lower end, right at 97.5 here of this Goldilocks channel here. So we are going to get some sort of a breakout move finally when the dollar's been pegged down here since June. Right here at this level. And once it breaks out, that will have a determining factor on the metals. If it starts to break higher, then that could send the metals lower. If it starts to break down, maybe following along with that chart of TNX moving lower on rates, then we could see an even further move to the upside in the metals. That'll be quite interesting to watch. We look at cryptos. They've been benefiting as well. There's the chart of BITB, one of the ETFs for Bitcoin. I like the ETFs on Bitcoin because with options on these ETFs, you can get better leverage than even buying partial coins. There is IBIT that some of you talk about quite often. It also has weekly options where BITB doesn't, but both of them have very liquid options. So either way, if you wanted to trade options, the charting program, all the signals that come out are based on the stocks, and then we create option trades around them. So if you're just a stock trader, it's still beneficial to have this. But a pretty nice move. Maybe we need to consolidate over the weekend here on Bitcoin because we had just a little bit of a breakout move here, got a little vertical, little separation from the 10-day moving average. So maybe that stabilizes a bit. Ethereum, perhaps maybe Bitcoin is outperforming Ethereum a little bit this time, where Ethereum had been outperforming Bitcoin for quite some time. As you know, we had this stair-step pattern up, sideways, vertical, sideways, vertical, sideways. And then we've consolidated in this kind of a descending triangle pattern. A quick reminder, descending triangle does not necessarily mean it's going to break to the downside. Any triangle can break either direction. And it looks like maybe we tried to break out here, but you can't really call this an official breakout because we have to take out this high of the trend line. Actually, what you could do is just move this line a little bit to incorporate that and say, it's just actually building a larger descending triangle here. And until these highs are taken out, you just don't look at that as a breakout. We could actually back up and back and fill a little bit here in the triangle, or maybe it takes off and runs. But again, I do think maybe some consolidation over the weekend would be warranted when we take a look at the crypto space. Let's take a look at the VIX real quick. When we look at the VIX, you can see that we are still, even with the government shutdown, I wondered if maybe that could spike the VIX because I was being asked about it so much. Again, I didn't think the markets would have much of a problem with it. They haven't so far. And asked then, as just to repeat myself, I think the government shutdown is really kind of meaningless for the markets unless it gets dragged out. We've been through this so many times, and the market knows that eventually they're going to reach a deal. But how long do they drag this out? Do they cause any economic damage before that happens? That could create a spike up in the VIX. But for now, we just continue in this descending triangle. We could break lower here, but I don't think it'd be much of a vertical breakout. This would be kind of a creep down because support is not very far below where we are in this big descending triangle, just down at 12.5 where we spent last summer on the VIX. So it seems like the path of least resistance would be an upward breakout. Perhaps that coincides with a little bit of a corrective phase. But this VIX breakout is going to be telling as far as what's going on in the markets and where we go from there. If we go take a look at the DIA, we've been talking in TradeFinder each week about what I've called radical rotation, where money has been rotating into different sectors and different stocks, but very quickly, quick ins and outs. The stock will be up big one day and down big the next. That's why I'm calling it a radical rotation. So we've talked about this during TradeFinder. And by the way, if you're wondering what TradeFinder is, we do it each and every week on Tuesday at 1 p.m. Eastern time. So it's during market hours. We look at the markets, we look for trade ideas, and we have a live Q&A. It's a great community. They interact with each other. They ask great questions. It's my most enjoyable event that I do each and every week. So you can sign up with the link on your screen, or you can go to ewotrader.com and sign up there. Again, it's free. So I'd love to have you join us next week. And so when we take a look at this rotation from the Dow moving back to the upside, we have seen maybe a little bit of flight to safety here as money is moving into the Dow and away from just the big tech stocks that have been driving things. And, we've had questions here on, is that wave 5 pattern really good because of the rule of alternation between the wave 2 and 4. Basically, that means if wave 2 is a mono wave, wave 4 should be complex, or vice versa, but they both shouldn't be mono waves. And some people have looked at that and felt like that was a mono wave, but I see a zigzag right here in the wave 4, where we have a nice correction of 50% there, or 61.8 rather, right at that fib level. And then there's the 100% extension, which is what you would expect. So it was a small zigzag, granted, but it was a technical zigzag. So I do think the rule of alternation has been satisfied here. And the interesting thing still remains to me that the SPY is in a wave 3. Then we go to the Dow, it's in a wave 5. And then when we go to the Qs, which have had a little bit of a renewed bid as well, the tech stocks have been doing well, or did well this week with this nice break here above the 10-day moving average and continuing to move higher. You see a nice little zigzag right there, which would imply that we may have a little bit more to the upside there to join the SPY with that target up to 675. So right here, since that did not make it to a 50% B wave correction, you only look for a 61.8% extension. So that would be kind of your general target area on the Qs, again, barring anything unforeseen going on with a protracted government shutdown. So it's in a wave 3. And then when we jump over to the IWM, that one is also in a wave 5. So we have the SPY and the Qs in wave 3s, and we have the Dow and the Russell both in wave 5s. It's not unusual for them to be labeled slightly differently, and I say slightly differently because the patterns are basically the same. They're all trending higher. But usually at some point they'll come into congruence and we'll have them all labeled the same way. So what's going to happen? Are we going to get wave 3s labeled in the Dow and the IWM, or are the SPY and Qs going to be relabeled to a wave 5? And then some have said, well, do they really have to relabel? Because when a wave 5 ends, you move back towards the previous 4. Since we've extended more than 100% here on the IWM, you only go down to a fib level. And with the two patterns, the SPY and the Qs in wave 3, starting wave 4 is still a corrective phase, and it's a fair point. We talk about what's usual and customary, and what's normal is that they tend to agree. But I would agree that both could move into corrective phases without any sort of relabeling coming. And we're getting another move higher. You can see the high on the IWM today, which a lot of people look at the IWM from a complete risk on, risk off thing, because small caps, higher beta. But they go with interest rates. We've talked about this a lot. The IWM is the most interest rate sensitive of all the markets because they're small companies. They need to borrow money. So as rates go down, that tends to put a bid under the IWM, and that's what's going on. I showed you how rates were going down on TLT and TNX. So that's put a bid, continued bid here in the IWM. 115% is getting pretty extended considering how shallow the wave 4 correction was. And we are in the middle of this tap box. So as long as rates stay lower, we could see this. A lot of talking heads on the financial networks have been saying that they're interested in this move in the IWM, and maybe they're branching out away from just the big tech with the extreme valuations and looking at the IWM. But regardless, it moved over enough to move that, or it made a new high to move that wave 5 over just a little bit, which is pretty interesting. Let's move into energy, and we did it. We had a call option in the speculative portfolio on UNG, expecting just an oversold bounce. And I say that because it's the whole supply demand thing. And then at some point in time, the sellers get exhausted. That's what I was looking for. No big technical observations or anything along those lines. It was just simply, it's been a very long move to the downside, and experience tells you that at some point in time, the sellers become exhausted and you get a bit of an oversold bounce. And it took a while. Every time it looked like it was going to go up, it got sold back. And then finally, we got the big move up here, and took that off yesterday for a nice little gain. And then midday, we got some storage levels, and it shows supply is still winning out. We know there's going to be demand. We don't know how much from the data centers, et cetera. We know the winter time is coming, but we have a lot of natural gas. We're the Middle East of natural gas. So it's that fight between supply and demand. Supply is still winning, but we did get the oversold bounce that we wanted. And at least looking at today's chart, it looks like we exited at a really good time, because now we're down today. So yesterday's exit looked great. Then we move to oil. Oil's trying to sneak out to the downside. We actually have a strangle in our level 3 portfolio and the volatility portfolio on USO, because that is a really nicely formed triangle. And you saw what happened with the triangle on GLD. My only concern here is with the downside breakout, how far will OPEC let this go before they flip the script? They raised production back here with the Israel-Iran conflict, and then we started to spike up again. Both those two times, they increased production to bring the price back down. They're managing the supply-demand curve in oil as well. I've opined on that before, so I won't go into that here. But if we continue this breakout to the downside here, at what point in time does OPEC say, we don't want oil to go down that far? They want it to stay elevated, and then they start cutting production rather than increasing production. That'll be interesting to see how it plays out. Now, as we go to stocks of interest, we take a look at NVIDIA. And by the way, we are doing the same thing we did last year, this year, where we're doing a giveaway each and every month of one of our level 3 portfolios, which does actually include the speculative portfolio that I've mentioned here. So it's actually 4 portfolios, but the 3 primary ones are time strategy, which is designed to generate income. And with income-based strategies, we have that event coming up. And you can sign up for in a couple weeks, where we're going to talk about income-based strategies, and it'll be really heavily talked about with the time strategy. Then we also have the volatility portfolio, and in addition to that, we have the impulse portfolio, which is the AI signals. All you have to do to qualify for the giveaway is leave a comment under this video, and you're in the drawing each and every month. We're giving away one for free. And if you go to our website, it's worth thousands of dollars for the level 3 package. So, and you get that speculative portfolio as a bonus. So I read all the comments. I answer as many as I can, time and travel permitted, but just leave a comment under there and you're in the drawing. So going back to the chart of NVIDIA, you can see here that we have a breakout above that wave 3. We are kind of getting into the tractor beam effect, and that's why I have this line drawn at 200. That's my nod to my dad and Star Trek. You know, tractor beams from planets would pull the Starship Enterprise towards them, etc. That's what the big round numbers do. Stocks just seem to gravitate towards them. Hard to imagine at this point, since we did break above that 180 level, that we don't make it up to 200. We're a little bit overbought right now, so kind of a pause today, but wouldn't be surprised to see NVIDIA reach 200. Amazon is starting to tick back up, but at this point in time, we're kind of in a wait and see mode, I think, on Amazon. I like Amazon long term because I think they're doing a lot of things right and they're branching out into a lot of areas. We had this run up. We made that new high from the wave 3 at the end of July, pulled back a little bit. Maybe we're going to come back down to the previous 4, which would be this level, but we're ticking up over the last 2 days. But to go long Amazon, a real aggressive move would be if you let it get back above the 50-day moving average, and then you could trade it up till it hits resistance here under 240 again. If you're more conservative, and I usually try to give aggressive and conservative views, everybody has a different risk tolerance. You know what yours is. And a more conservative view would be let it break that 240 level, and then we still have room up into this wave 5 tap box around 260. So I think it's kind of a wait and see mode there on Amazon. Apple talked about how people really wanted to go long Apple. The AI was ho-hum on it. It gave it a 50% chance that it would go up and hit this level. And it did that way back in August, and it did in September, about a month later. And look, we've just pegged right here at that AI level, but we got slightly overbought. Apple doesn't move too far from its 10-day moving average very often. People wanted to go long. I don't know that Apple really gave them a reason to. The iPhone 17's out and everything, but they're putting off their AI stuff. But the market wanted to go long Apple, and it has, and it's pushed it to the upside. We're still in a wave 3, a little consolidation here. Perhaps we can go higher. I like to look at the DMI in a situation like this. And the ADX is still moving up. There's still good separation between the two directional indicators. The negative is pointing down, so sellers aren't stepping in yet. So perhaps Apple is able to continue up to its next fib level on this move higher. Now, that would be the second extension because it only had a 38.2% B wave correction. So that gives your first target 61.8. And then the extended target, again, happens a lot in a wave 3, is 100%. Well, we're breaking above that now, too. And it's rare that you go to a second extension, but it does happen, and maybe Apple's going to be one of those that does it. Then ask about Netflix a lot. You saw the headlines, Elon's post, and wanting people to cancel their subscriptions. I'm not going to go into the details of what it was, but there's some protesting going on against some content, and that sent Netflix down for a few days. But it just got it down in here to this wave 5 tap box. Now, we do have this big symmetrical triangle. So with this much of a downward move, we have to respect that we could move even lower on Netflix. I don't think it'll be just because of that headline. Those tend to be shorter-lived events. In the past, stuff like that hasn't been a long-term effect. It affects things more on a shorter-term basis. But breaking below this level here where the wave 3 was, at least long enough to label the 5, is concerning on this being a confirmed downside breakout. But we're back up above that 1150 level today. It may just be an oversold bounce because on the low yesterday, we were a little separated from the 10-day moving average. You know the rule, no security in any time frame gets too far from the 10-day moving average, at least not for long. And that's a good rule to follow in your own trading repertoire. But we just were oversold, and maybe we're just bouncing back up. So I think we got to keep a close eye on Netflix. There might be a downside trade here to continue if we do get follow through on that break to the downside. Perhaps that prompts people to start rotating away from such a high dollar stock. And then we look at Super Micro. Thought this one might catch a bid. This kind of been more speculative. You can see no Elliott wave pattern right now. That tells you it's in a big corrective phase. The software with the algorithm will label the ABCs if you want it to. I turn it off because I like to put the tools on myself rather than have the software do it. But breaking up here, we had resistance at 45. We knew that. That's why that line was there. We went sideways there. The next level was 50. Said it'd probably get there pretty quickly. It did. Now it looks like it's got its eyes set on 55, and then we'll see. Then it gets really interesting. If the market does stay strong and it can break above 55, maybe a brief test here of the highs at 60, but SMCI could be one to take off. And we're getting into that period. I talked about the radical rotation. Well, we're going to get into the area of time frame where investment managers that have underperformed the S&P are going to be chasing performance because that's where their big money comes from, bonuses by beating the S&P. So if they don't, then they still make good salaries, but the big money's from the bonuses, and they'll be looking for areas that haven't participated in some of the big, huge runs. Where can they get the best bang for their buck? And a stock like SMCI might be one of them. We are a little bit overbought from the 10-day moving average here as we approach the resistance at 55. So some backing and filling, something along this lines here, some sideways even a little bit of give back before trying to break 55 would be healthy. You don't want to see a stock break resistance when it's already overbought, because then that breakout tends not to hold. So keeping a close eye on that one. Mara, in the miners space with cryptos, we're right up here. We had this AI target going all the way back to July. It hit it. We backed off. We came all the way back down here into this channel of support and went sideways. We've broken up towards that area again. This one's a pretty easy read here. Whether you're aggressive or conservative, the prudent thing to do is let it break 20. If it can break above 20, it might be off and running. Clean air, my racing analogy, you're out front. Engine runs better because you're in clean air. You don't have a little tire pebbles and hot exhaust coming into your own engine. But it needs to do that first. So I would keep an eye on Mara, but again, I like to see it break 20 before trying to go long there. AMD has broken from this long consolidation that it had, basically a bit of a triangle formation here as well in AMD. And so the little bit of a breakout there. We've got a little bit of resistance right in this area here. It can extend this line over a little bit above the 10-day moving average, so maybe a little sideways consolidation here right underneath this 170 level. But if it can break that, then we could be off and running. We've got a decent wave 4 here right at the 38.2% fib level. The algorithm still has a green, though, which means it's still active. So we have to watch if this resistance level becomes too strong. But at this point in time, it looks like AMD may want to make a run. Now, the ADX is still too low. It has ticked up, but it needs to get above 20. So maybe a little bit of sideways, drift higher, let the ADX catch up, and then you could feel a little more confident about it breaking that 170 level. But for now, I think AMD is kind of a let's watch and see how that plays out as well. Last thing, it does have this triangle. Pretty decent sized mouth of the triangle here. And if this is the upside breakout, it's not following through today. Remember, you have to have a follow through or confirmation day. So we have to respect that to be a false breakout, at least at this point. But if it can take out yesterday's high and close higher than yesterday, then that's a confirmation day. And perhaps that's enough to propel it through that 170 level. Last but not least, taking a look at Alibaba. We have just a meteoric rise here. I was wrong on this. I thought anything China, Alibaba, NEO, all the stocks, the FXI in general, were all good places to be until we had that video of the presidents of Russia and China getting all chummy, and I thought that was a bad optic, and I thought maybe the administration might come down a little harder on China with the tariff arguments that are going on in the negotiations and stuff. I didn't feel like they would be too keen on that because the president's not real happy with Putin, who seems to act like he wants to end the war and then doesn't do it. But it didn't. It affected it for a couple days, and then bam, off and running we went. Now that's awfully vertical. No way my disciplines will allow me to chase a move that vertical, that quick. We're above the 10-day moving average. And then it's been so vertical. We also have another thing I want to mention is the 10-day moving average is separated from the 50-day moving average quite a bit now. You can see usually they're a little bit more in concert with each other. So when that separation occurs, it's kind of the same rule as no security in any time frame gets too far from the 10-day moving average. So usually those two will come back together as well. So my point is that I feel like some pretty good backing and filling may be due for Alibaba at this point in time. But if you caught that move, congratulations. Thanks as always for your attention. Have a great weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.